Ever wondered how some traders seem to predict the market even before it moves? The secret is in the candles. Today I'm going to show you the most powerful candlestick patterns so you can trade like a pro. These patterns are used by top traders and even automated trading systems. And I'll show you not only how to spot them, but how to combine them with price action to boost your win rate in trading. Plus, I have some bonus tips so you can avoid fake signals and a simple tool that highlights candlestick patterns automatically, so you won't have to memorize them at all. So stick around because this is going to change the way you trade. So why do candlestick patterns work so well? It's all about visualizing market psychology, the ongoing battle between buyers and sellers. Big body candles shows who is in control, buyers or sellers. Long wicks, on the other hand, shows you where price is being rejected. These patterns give you early signals how the market is going to move, often before even any technical indicator catches on. And here is a tip to keep in mind. Don't rely on candlesticks or candlestick patterns alone. Combine them with other trading systems like support and resistance, trend lines, or supply and demand strategies for maximum effect. That's when the real magic happens. So let's dive into the most powerful candlestick patterns you need to know to become a better trader than you are right now. And I'm going to show you every candlestick pattern that you need to know, what impact this candlestick pattern has on the market, and a pro tip how you can better spot them and then connect them to your trading strategy so you can use it to buy or sell your trades better. First is an engulfing candle. An engulfing pattern is a powerful visual signal that appears when a large candlestick completely engulfs the previous candle's body. This means that the range of the new candle fully contains the range of the previous candle, including its opening and closing prices. For buyers and sellers, this represents a significant shift in the market sentiment. For example, in a bullish engulfing pattern, a large green candle fully engulfs or fully overtakes the previous red candle. This suggests that after a serious period of selling pressure, buyers have stepped in forcefully enough to reverse the downtrend. The sheer size of this green candle not only shows that buyers absorbed the selling pressure from the previous session, but they also pushed the market price much higher, closing well above the previous open. And for the selling traders, this can be a warning sign. The bears or the bearish traders, the traders that wanted to sell in the market, have lost control. And if the pattern forms at a key support level, it suggests that buyers see value at this price and are ready to drive the market upward. This creates a potential shift from a downtrend to an uptrend. Conversely, in a bearish engulfing pattern, a large green candle completely engulfs a smaller green one. This indicates that sellers have overwhelmed buyers, pushing the price lower and reversing any prior upward movement. At key resistance levels, this pattern signals a strong rejection of higher prices, often leading to a continuation of the downtrend or a sharp reversal. From a market perspective, engulfing patterns often occur at pivotal price points, where traders expect reversals, or where major institutional players are entering or exiting their positions. When you see an engulfing pattern, especially in combination with trend lines or support and resistance levels, it can mark a key inflection point in the market. And a pro tip for engulfing patterns: look for confirmation in the next candle or additional price action cues, like volume spikes or broader market sentiment, to increase your confidence in the reversal signaled by an engulfing pattern. Next up is pin bars. A pin bar is a single candlestick with a very small body and a very long wick or shadow. Either are above or below the body, depending on whether it's bearish or bullish. This pattern is a visual representation of price rejection at a key level. For a bullish pin bar, the candle opens, moves significantly lower during the session, but then reverses direction and closes near above its opening price. This forms a long lower wick and a small body at the top. For buyers, this indicates that sellers tried to push the price down, but buyers overwhelmed them, reclaiming control and driving the price back up. When this happens near a key support level, it's a strong indication that buyers consider this level as a floor, suggesting potential for an upward reversal. For sellers, at the other hand, a bullish pin bar signals loss of momentum. Their attempt to break lower failed, which might trigger stop losses, or they even want to revert their short positions and go long, adding to the upward momentum. In contrast, a bearish pin bar forms when the candle opens and rallies upwards, but reverses sharply and closes near or below its opening price. This creates a longer upper wick and a small body at the bottom. Here, buyers attempted to push the price higher, but the sellers stepped in too strong, reversing the move and dominating the closing price of this candle. At key resistance levels, this pattern warns that the buyer's strength is fading and sellers are ready to push the price lower. And a tip: market-wise, pin bars often reflect a sharp shift in sentiment from optimism to pessimism or vice versa, and are most powerful when they appear at strong support or resistance levels. And they are also favored by price action traders for timing their entries with tight stop loss placements. Next, of course, and you probably know this one, is the momentum candle. A momentum candle is categorized by a large body, typically 2 or 3 times bigger or more than the previous candle. It represents a sudden aggressive move in one direction, either bullish or bearish. For buyers, a large bullish momentum candle signals that they've taken overwhelmingly control. This often happens when a key resistance level breaks, or after a period of consolidation, where many traders were uncertain what to do, buy or sell in the market. As the price breaks out, stop loss orders from short positions are triggered. Essentially, they have to leave the trade because the stop loss was triggered and they are out, adding fuel to the upward movement. And then buyers not only push the price higher, they also create a wave of panic among sellers, causing them to cover positions. This snowball effect results in a strong rally upwards. So when a big bullish momentum green candle is forming, for sellers, this is a red flag. It shows that their control has essentially been lost and a strong buyer move is underway. And then sellers might be forced to exit their positions, leading to even more upward price movement. Conversely, a bearish momentum candle is when sellers take over, often after a failed attempt to move higher or a breakdown below support. It signals that the selling pressure is accelerating. And for buyers, this should be a warning sign to exit their long positions. On the other hand, for sellers, of course, it's a signal to enter or add to your short positions. In a broader market context, momentum candles often occur at breakout points, especially when price finally moves beyond a long-standing consolidation range. These candles are crucial because they tell us that significant players like institutions or large funds with a lot of money are active. And if they want the market price to go somewhere, probably everyone else jumps on that wave. This can kick off a new trend or accelerate an existing one. And a tip for you, while momentum candles are exciting to trade, it's essential to confirm the move with volume and context. A big candle without volume might be a false signal, but when accompanied by a strong trading volume, it's often a reliable indicator of trend strength. The next candle you have to know about is the doji candle. A doji candle is a unique formation where the opening prices and the closing prices of this candle are nearly identical, resulting in a tiny non-existent body with long wicks on both sides. This pattern visually represents a moment of indecision in the market, where neither buyers or sellers have the control or know where they want to go. For buyers, so you are betting that the market is going to go up, a doji candle can be a signal of the upward momentum stalling. If the market has been going up and a doji candle appears, it suggests that buyers are hesitating and sellers are maybe preparing to push back. This can serve as an early warning sign to reduce long positions or tighten your stop loss levels. For sellers, on the other hand, so you are betting that the market is going down, a doji candle appearing after a downtrend indicates that selling pressure might be losing steam and buyers could be stepping in. This hesitation often precedes a potential reversal or at least a slowdown in the existing trend. In the broader market context, doji candles frequently appear at key levels like support and resistance or after strong price moves. They act as pause points where the market is evaluating the next direction of the trend. This makes them useful markers for traders to anticipate breakouts or reversals. But doji candles alone are not strong entry signals. They need confirmation from the next candle or other technical factors. For example, a doji candle at a key support level followed by a large green candle is a strong bullish reversal signal. So the market might want to reverse the downtrend and go into an uptrend. On the other hand, a doji candle at a key resistance level followed by a big red candle confirms a bearish reversal. And also a tip for you, the psychology behind a doji candle is important. It reflects an equilibrium between demand and supply. Smart traders look for dojis where price action has context, like confluence with trend lines or key levels, and then they wait for confirmation before making a move. Next up is a hammer, or also called a shooting star. A hammer and a shooting star are both single candle patterns with a small body and a long wick, but their positions and implications differ dramatically. A hammer has a small body near the top of a candle with a long lower wick, often at least twice as long as the body. This pattern occurs when the price of a candle is opening, then it falls significantly during the session, but then buyers step in, pushing the price back up to close near the opening level. For buyers, this is a sign of strength and resilience. It tells them that despite heavy selling pressure, buyers see the value of the market and are willing to push the price aggressively. When a hammer appears at a key support level, it suggests a strong rejection of lower prices and a potential reversal to the upside. For sellers, the hammer is a warning sign. It shows that despite initial selling success, buyers have overwhelmed the move and are likely to continue to push the price higher. Sellers might use this signal to cover shorts or avoid new selling positions. On the other hand, a shooting star has a small body near the bottom of the candle and a long upper wick. This forms when the market or the candle opens, rallies strongly, but then sellers regain control and push the price down, closing near the open. For sellers, this is a sign of dominance. They've absorbed the buying enthusiasm and are ready to drive the price lower. This pattern is especially strong at key resistance levels, indicating a rejection of higher prices and a potential downward reversal. For buyers, a shooting star is a red flag. It tells them even though the market attempted to push higher, sellers stepped in forcefully. This might prompt long traders to tighten stops or exit their positions. In the market context, both patterns reveal sudden shifts in sentiment, from bearish to bullish with a hammer, or from bullish to bearish with a shooting star. These patterns are especially reliable when combined with price action levels or trend lines, providing traders with clear visual cues to anticipate reversals. And here also a tip: wait for confirmation after a hammer or a shooting star, like a strong follow-through candle, to increase the reliability of the signal. So now we have only two more important patterns or candles to go. Next up is the Marubozu candle. A Marubozu candle is a single candle formation with a large body and no wicks, neither at the high nor the low. It represents a session where the price opened at an extreme, either high or low, and closed at the opposite extreme with no interruptions. This pattern signals strong momentum and clear dominance, either buyers or sellers. A bullish Marubozu candle forms when the candle opens at the session's low and closes at its high. This indicates that buyers controlled the market and the price action of this candle from the very first trade to the last moment the candle closed. For buyers, this is a clear sign for overwhelming demand in the market, and it suggests a strong upward movement. When it appears after a period of consolidation or at a breakout move above resistance, It often marks the beginning of a sharp upward move. For sellers, a bullish Marubozu is a strong warning signal. It shows that the sellers were completely overpowered by the buyers during the session of the candle, and holding short positions could be dangerous. This might trigger a wave of short covering, further pushing the price higher, because short traders are exiting their trades. A bearish Marubozu conversely opens at the session's high and closes at its low. It indicates that sellers dominated this session of this candle, driving the price down with no resistance from the buyers. For sellers, this candle provides a strong entry confirmation for short trades, especially when it appears after a failed breakout or at a major resistance level. For buyers, a bearish Marubozu candle warns of a potential collapse of the price. If this pattern forms at a key resistance or during a downtrend continuation, it signals to tighten stops or maybe consider exiting your long positions. So, in the market context, Marubozu candles are particularly significant because they represent a decisive, uninterrupted move of one side of the market. These candles are often seen during news-driven moves or high-volume sessions, and can signal the start or the continuation of a strong trend. And like last time, a tip for you: pay attention to the context of the Marubozu candle. A sudden large move in one direction can create sharp reactions, but volume and follow-through candles are key for your confirmation. And last but not least, the morning star or the evening star pattern or candle. A morning star and an evening star are classic 3-candle reversal patterns that signal a potential shift in the market sentiment at key levels. These patterns combine elements of momentum, indecision, and follow-through, providing powerful insights for traders. A morning star starts with a large bearish candle indicating strong selling momentum. The second candle is a small-bodied candle, often a doji or pin bar, indicating market indecisions. The third candle is a large bullish candle that closes well above the midpoint of the first candle's body. For buyers, this sequence signals that after an initial wave of selling, the market found support, and buyers have regained the control, driving the price upwards. For sellers, the morning star pattern is a warning sign. The initial selling pressure was absorbed, and the failed continuation suggests a possible trend reversal. This might prompt short traders to cover positions, adding fuel to the upward move. When this pattern appears at a key support level, it's a strong bullish signal, especially if combined with high volume or other technical indicators. Conversely, an evening star starts with a large bullish candle reflecting strong buying momentum. The second candle is a small-bodied candle like a doji or pin bar, showing indecision as the upward trend stalls. The third candle is a large bearish candle that closes well below the midpoint of the first candle's body. For sellers, this indicates that after strong buying, the market faced resistance, and sellers stepped in with enough force to reverse the trend. For buyers, the evening star is a caution flag. It tells them that upwards momentum is weakening and the risk of a reversal is high, especially if the pattern forms at a key resistance level. This can prompt profit taking or tighter stops. In market context, both morning and evening stars reveal a dramatic shift in sentiment and control. They combine initial momentum, hesitation, and strong reversal, making them reliable reversal patterns. And as always, a tip for you: look for confirmations when you see these patterns, such as strong follow-up candles or volume spikes, to increase your confidence in the reversal. And now that you learned all these candlestick patterns, how do you actually use them in real trading? You have to combine them with price action, support, resistance, and trend lines. Look for confluence, like multiple signals lining up for a high probability trade. But also be cautious, false signals do happen. Not every candlestick pattern shows you the way the market is going. Always confirm with the context. Check the overall trend, look for news happening in the market, and consider market environment before entering a trade. And here's one final bonus tip for you. If you're using TradingView or similar platforms, you can set up candlestick pattern indicators that highlights these formations automatically. This saves you from memorizing every pattern that you learned and lets you focus on execution. And remember, candlesticks aren't just pretty shapes. They reflect fear, greed, and raw market emotion. Master reading them and you'll be one step ahead of the other traders. Now you've got the tools to read candlesticks like a pro. But remember, no pattern works 100% on its own. Combine them with price action and solid risk management to maximize your success. And if you learned something new today, hit that like button and subscribe for more deep dive into strategies. Also, drop a comment below which candlestick pattern is your favorite or which one you are struggling the most with. My favorite candlestick pattern is the doji candle combined with the momentum candle. So now go out there and search for these candlestick patterns so you can trade like a pro. And I hopefully see you next time.